Good morning, everyone, and thanks so much for joining us. It's a beautiful day out there. I know there's a lot of competition we have, but today is an exciting day to talk about getting beyond venture capital, and Tracy Osborn from Tiny Seed is here to discuss that with us today. So welcome. I'm going to be facilitating the workshop today from behind the scenes. My name is Carrie Ramsey, and I am the project manager for the We Can project, which is led by Queen's University and which is a part of the Women Entrepreneurship Strategy funded by FedDev Ontario, which some of you may know about. Something I haven't shared before in these workshops is that the Government of Canada is actually aiming to double the number of women-owned businesses by 2025. And I often say to our weekend clients that there's never been a more exciting time to be a woman entrepreneur. And so it's great to have you joining us today. And I know that there will be some more that will be admitting into the room as we go. Just as I like to do before we get started, if you wouldn't mind sharing with us where you're connecting from today. You do have your chat button that's available on your Zoom screen. And we'd love to know where you are joining us from, as well as the name of your business, if you'd like to share that. We always like to find out a little bit more about the individuals who are joining us. Of course, our We Can workshops are not only learning opportunities, they're also networking opportunities. So we hope that you'll connect with women, whether they are in your same region or perhaps they are beyond your region. Of course, now with our virtual workshops, we have women making connections with other women owners right across the country and beyond. So that's awesome. While you're just letting us know where you're connecting from in the chat, I will acknowledge that I am connecting from Belleville, Ontario. Although Queens itself is in Kingston, during COVID, I've been working from Belleville. And this is the traditional territory of the Huron, the Haudenosaunee, and the Anishinaabe peoples. And I was thinking about what that means to me today, because I don't just like to do a land acknowledgement without thinking about it. And I was thinking today, since we're talking about funding and economics, that's certainly trade and the birth of, trade, selling and exchanging goods, services started centuries ago. And even then, it was about human beings. And what has been interesting during this time of COVID is that there's been this shift in mindset. And I don't know if you've heard the phrase, we're moving from B to B to H, which is moving from business to business to a human to human. And so as it was all those centuries ago, I hope that today we'll remember that what we're doing in our businesses, whether it's products or services, really it's about human beings. And I hope that's what we're all about. It's most likely what this group is about. So I'd encourage you to engage today with this workshop and as well share with us, like I said, where you're from. By the way, if you're interested in knowing which of the First Nations territories you are connecting from, you can visit www.native-land.ca and you can find out a little bit more about your region. But without further ado, I'd like to turn the virtual floor over to Tracy Osborn, who's joining us from Toronto today, I believe. She's, you're gonna see her in just a moment if you can't already. I was teasing her yesterday during the tech check that it looks like she has a polar bear draped on her chair, which you'll see in a moment. I'm not sure if I'm sure it's not real, but welcome, Tracy. And we're so excited to have you share with us today beyond venture capital.
I know I get I get so many comments about my chair. And it's just literally just the sheepskin rug I got from IKEA, but it spiffs up your office chair when you have to work from home all day. All right. So to get started, when it comes to questions, because I have like a dual monitor set up here, I actually cannot see the chat. So I think Carrie said that she'll pop in every now and then if there's like a particularly relevant question, but I have time at the end of the presentation to kind of go through all those questions once I can see them. So feel free to throw the questions in the chat and we'll get to them at the end, unless it's like particularly relevant, in which case Carrie will interrupt me and we'll take care of it then. All right, come on, Keynote. There we go. All right. As mentioned, I'm Tracy. I'm Tracy Makes on Twitter. So I will feel free to connect with me on Twitter if that's something you like to use, or Instagram or whatnot. I probably will be, I'll probably throw up the slides after this talk onto Twitter, put them on SlideShare and whatnot. So if you want the slides pretty quickly, if the recording is not up yet, you can also ping me for those. So this is one of the things, I'm going to go through some of the things that I've worked on in my career. One of the most significant is my book, Hello Web Design. I also have another book called Hello Web App. This is my design, excuse me, my background is in design. I have a degree in graphic design. I'm originally from California. And I went to Cal Poly San Luis Obispo in Central California. And I kind of jumped into my career of working in web design. And then I moved into working at startups. And this is one of my personal projects that I've been working on for the last couple of years, is this book on teaching web design. And the other big thing that I work on right now, as mentioned, is I work at Tiny Seed. Tiny Seed is a startup accelerator designed for SaaS bootstrappers. It's a place I landed after this is what I did between, working on my books. I started a startup called Wedding Lovely. I ended up shutting down the startup a couple of years ago, and I've been working at Tiny Seed since. And so a lot of the information in this talk is kind of based around my experience of A, working in the startup ecosystem, A, being a woman in technology, or B, being a woman in technology, and C, working at Tiny Seed. And I'll go into information more about Tiny Seed at the end. But all these kind of areas, I wanted to mention that this talk is going to be a little tech centric, because that's kind of where my experience is of working in startups and working in tech. And I did throw in some broader examples in here, but I will say that the slight majority of this information is going to be based on tech businesses, though I do cover some other things. So I just wanted to give everyone a heads up about the kind of the focus of this talk before I really dive in. So before I start talking about financing, I wanted to go over a really important point that I find a lot of people, especially new entrepreneurs, kind of struggle with. And it's a hard one. It's that when you're looking for financing, some sort of money or whatnot to finance your idea, having proof of traction or product market fit will make everything a lot easier. And by that, I mean, you need to have some sort of proof that people are are interested in what your idea is. So if you're, say, building a product, having proof of traction could be something like having a lot of newsletter signups, or a lot of people following you on Instagram, or a big following on like Kickstarter, those other platforms. If you're building a technology product, having some sort of like pre-launch mailing list that people have signed up and add their interest to it. Maybe even some maybe you have like a pre-launch where you can do pre-orders and you can show how many people have already pre-ordered your product. Getting funding for just an idea, if you have, and it doesn't matter, it could be like a really, really awesome idea, but just an idea, especially as a new entrepreneur, is extremely difficult. And it's hard because you see all these like stories, usually white dudes, where they get this idea for this beautiful app, and it looks like people are just like throwing money at this person. And this person goes way farther because, now they have the money to hire out and spend money on ads and whatnot. And this can happen to someone who doesn't have proof of traction, doesn't have some kind of product market fit, some kind of proof that people want the idea that they build. But really, it really is so, so rare, especially if you're not already like an experienced entrepreneur, and you have, sometimes proof of traction can just be proof of previous experience, which is why a lot of people who've already say built and funded and sold a business, it's much easier for them in the future to get money just for an idea. So this sucks. It's something I struggled with at Wedding Lovely when I was raising money for my startup, because the idea of Wedding Lovely was to build this app that helped walk people through wedding planning and connecting them with vendors. And it's all these things that I really wish existed in the wedding industry, but it's extremely hard to build without funding because I was a new entrepreneur and I didn't have a lot of proof of traction, I was unable to raise this. This is venture capital, but still this advice kind of applies for these other platforms as well. So it's something that I've definitely experienced in startups. It's something I usually counsel new entrepreneurs that it's really useful to spend a lot of time in the beginning just getting a lot of proof for your idea before going out and looking for money, which sucks because sometimes you need money to help to to help build that proof. But, you know, so you can take time off your job or whatnot. So sometimes you have to be really clever in how you get that proof and how you spend your time. But this is something that's really, really important. And it's just really want to counsel not to, that's really hard to just get funding for just an idea. So let's start moving into kind of the giant landscape of funding options. And this is extremely broad. I was, you know, like I said, my experience is really into the tech world. And then when I moved out from the, you know, with my research from the tech world into the broader landscapes of just like general entrepreneurship, it got very overwhelming because there's so many options out there. I'm going to kind of narrow it down just into two different paths that a lot of people use in general when it comes to tech products, but also some other areas like physical products or whatnot, where the choice was between raising venture capital or bootstrapping. So by venture capital, I mean raising money from a group of investors. Usually the investors, you can reach out to these investors, tell them, you know, show them your product, show them your proof of market, show them your, you know, the idea and all the traction you have. And then you essentially sell a piece of your business. So this investor comes on board with a big chunk of money. And you can do things farther and faster because, you know, while you've lost like technically ownership over a chunk of your business, you have this, you know, chunk of money to help you build things, hire engineers, hire marketers, hire salespeople, work on your product, et cetera. And by bootstrapping, I mean funding your company solely through yourself or through the profits from your business. So you're not taking any outside money. So a lot of times, a lot of people look at this realm as like you know, there's only two paths you can do. You can either raise venture capital or you can bootstrap. And you can kind of see this here for this this graph I found off of Lighter Capital, which I'll kind of cover later as one of the financing options. It kind of shows the progression when you have these two paths. If you just look at those top two lines. So with venture capital, it's, you know, it's not just like you take money from venture capitalists and then you're done. Here's like the major downside of taking money from venture capitalists is that you're expected to go on this path. And so you can see that it kind of starts from, you know, bootstrapping or friends and family money to raising your angel round to range. And then it's expected, very highly expected. It's very, very rare if you don't because investors want you to continue to raise money and continue to grow your business at a really fast pace. So you're really expected to say, once you raise your angel, then you have to start prepping for raising your Series A, and then you have to start prepping for raising your Series B, and then you have to start prepping for IPOing and whatnot. And this is the hard part of venture capital is that, you know, it sounds really romantic to have these investors invest in your business and then you just get enough money to grow. But really traditional venture capital expects you to do this like go big or go home type path. And a lot of venture capitalists won't invest in you unless they think that you're on this path and this idea of, you know, again, constantly raising lots and lots of money and growing your business really large. This is particularly relevant for tech companies. Whereas you can see here, like the second thing, the bootstrapping has a lot less steps and there's a dot in the middle, which I'll cover, which is called revenue-based financing. But really bootstrapping is simpler because it's harder, but it's simpler because you're just investing your own money or investing the profits from your business. And then we'll talk about the blended stuff in a second. So bootstrapping, just to cover that first, is founding and running a company using only personal finances or revenue. And the advantages of bootstrapping is that you and your co-founders keep 100% ownership of the business, which is really great because, you know, when you have other owners in the business, those owners can, you know, affect decisions. They can, especially if sometimes when tech companies raise enough money that they drop under 50% ownership, then those founders, there's stories about founders being kicked out by the investors because the investors now they own the majority of the business and they can make those decisions like saying, hey, these founders are no longer right to run the business. They're going to get pushed out and we're going to hire a new CEO. So this is really nice. If you have 100% ownership of the business, obviously you don't have anyone telling you what to do. You have complete freedom to grow your business as you like it. I'm not going to read this whole thing, but it was this article by a software founder, Alex Yumashev, who was talking about why he bootstrapped. And he said, like, when you're self-funded, your only boss is the client. The client, your customer, the person you're working with, is the only person that you have to please. The client is the only person that you have to report to. So it kind of talks about, why, especially for like an online software business, why it's so nice to not have this like overhead of investors. But there's some major downsides to being bootstrapped. So if you're a tech business, if you're working on SaaS, which is software as a service, which essentially means that you're like, say, programming you have a program that's doing a service for someone automatically. So what's going to say, like, my brain is blanking. Anytime you like use a service online, that's a program. You sign up and you pay for it, and it's like all automatic behind the scenes. It's usually software as a service. There's a lot of people who are building these tools, programming these tools for people to use and people to buy. But there's this concept called the long, slow ramp of death. It means that whenever you're building this software product and you're bootstrapping it, there's always going to be this like really long period of time as you try to find more customers, and because you're not paying, you usually don't have enough revenues to pay for like ads or any kind of like marketing or something like that. You have to like, it can be a really long time until your software business takes off. And so these are some businesses that are doing so fabulously well now, but you can see that there is this like gigantic period of time where it's just like slowly climbing, and they're, the founders are probably wondering if this business is even going to work out until there's this like moment. My coworker, Rob Walling, calls this escape velocity, that the business takes off and suddenly you're a quote unquote success. But really, if you're bootstrapping, say even like a software business, there's this like natural time period that happens to almost all people who are working in these software businesses, where you're just like kind of like slowly climbing the ranks, and like it can be really stressful. So it's an agonizing time for Cart Hook took them 27 months to reach a point where their business was like growing to a point where they knew that it was going to be successful. My coworker, Rob Walling, again, this is something he shared with me. He's he was the founder of Drip, which is an email marketing tool, and sold Drip a few years ago. And he is now the person who runs TinySeed. Drip is a very big software product. He was able to sell it for a life-changing amount of money. But even for him, it took him 13 months to get to a point where he was, again, the business reached that escape velocity. This hub staff, very slow climbing line, and took him 12 months to start like getting even like a noticeable uptick in that line. So with bootstrapping, you have to be a lot more efficient with your capital. You have to always be thinking about how you can reduce costs. And getting to product market fit is slow. It could be faster if you had another salesperson, another engineer, be able to pay for those ads now. So in terms of bootstrap businesses, there's actually a few big businesses that are bootstrapped, including Spanx. This kind of blew my mind because I think everyone knows what Spanx is. And they've never, or at least I want to recheck this. It just seems so mind-blowing to me that Spanx is a bootstrap business, that they don't have investors on board. So that's like a really huge example of a product business that was able to grow simply through bootstrapping rather than taking venture capital. And then there's a lot of, there's more examples in the tech world of successful bootstrap businesses, especially because of tech, you don't have a product, you don't have to do inventory, all that kind of stuff. So the company Basecamp, which builds a lot of tools, including an email tool called Hey, which they just launched, are bootstrapped. They don't have investors. If you're a designer, there's this company called Balsamic, which allows you to do mock-ups. They're also bootstrapped. So for all these companies, growth was probably a lot slower than if they'd had money, but they were able to grow to the point where they are successful, that they are, the founders are, probably living very nice lifestyles, and they don't have investors potentially telling them what to do or how to run their business. But there are upsides to venture capital. The upsides is that there's money to accelerate growth and you have built-in advisors. So by money to accelerate growth, like I said, you can hire those salespeople that can really like turn around your business. You can pay for that product, pay for that inventory. You have the capital to kind of like get the things you need faster. And by built-in advisors, a very real benefit of having investors on board is that, usually investors, people who have the money to invest, have also been successful business people and entrepreneurs. And so they have the advice, they have connections, they have this advisorship built in. And because they're investing in your company, they're invested in making sure that your company is a success. So it can be really great if you have like a certain type of business and you get an investor on board who has a lot of experience in the area that you're in, then that's also a way that you can accelerate the growth of your business, because you can use the experience of your advisors, of your investors. And downsides, like I said before, once you're on the VC track, it's really hard to get off, because generally VCs want you to raise more money. They want you to go big or go home, because that's the only way that they're going to have the exit that they need. It's been funny. Tennessee is also an investment firm. So I've never invested personally myself, but I've had a view into what it's like at an investment firm and how much investment firms are so beholden, which kind of makes sense. It kind of sucks, but kind of makes sense. So beholden to having the return numbers. You can say like, 10x return, because venture capitalists, especially firms where they have a bunch of investors in the firm themselves. They are like, okay, we're only going to invest in businesses that are going to give a 10x return, so we can return this money back to the people who are investing in the firm. And so it turns into this like crazy money conversation, which is why they're so particular, and they want to make sure your business, if they're going to invest in you, can return that amount, can do those like gigantic returns, so that their investment firm can be a success. So that's back to those stages of those that VC-backed progression. Downside to VCs is that usually not so much. If you get like small amounts in the beginning, this is not a problem. But when you start moving into Series A or later, the VCs, the investors, want to have a seat on your board. And when they have a seat on the board, they have a say in how the business is run. And again, that's a place where if there's conflicts, if there's anything that, that there's people who are helping you run your business that can have opinions that are contrary to yours. And if you're the founder of business, obviously you're very, you want to keep 100% control of your business, but something you don't because you've lost a board seat. So when you have VCs, if you're going to go to the VC area, you really have to make sure that people you partner with are people that you trust. In general, pressure gets a lot higher because those VCs want those returns. Investors can block a sale. So, this kind of happened at Wedding Lovely. I almost sold to Etsy, and the thing, it fell through that's a whole long story. But in my terms, Wedding Lovely was funded by 500 Startups Accelerator. And the 500 Startups Accelerator's terms that they gave me, there was in like this gigantic document of all the investment terms, there was a thing saying that if there was going to be a potential sale, and the potential sales under a certain amount, they can block that sale. So they can force the person who they invest in to not sell at a point where they would potentially not make those returns. 500 ended up waiving that for me, but it's something that I've seen other people have huge problems with. And like I said, my acquisition didn't go through anyways. And in general, the VC world discourages capital efficiency because, again, it's that go big or go home thing, which kind of, it's rough. I'm a pretty frugal person. I want to, be smart about the choices I make at my company. And, they want to see that if they invest in you and they invest money in you, they want to see all that money is spent. And then you're raising your next round as fast as possible. And so you just there's the stories about these startups in San Francisco that have these giant lavish offices. A lot of it has to do with the fact they have this, chunk of money from investors, and investors want them to use it so they can start raising more money. So they're like, okay, cool, beautiful offices, hiring a fancy architect, all these kind of things. I'm kind of happy about COVID is not great, but the office thing, especially when I was in San Francisco, was kind of crazy. And just seeing all of this like money poured into something crazy, like beautiful offices. I'm hoping that, in this world of everyone working from home, I'm hoping like money starts coming back down to the workers than being spent on like architects and fancy offices. That said, on VC in the tech world, if you're in the tech world, there are terms, there's like things being put in place that are more founder friendly. So in general, it's kind of shifting in a better direction, but it's still really slow. Whereas before, when you would raise money, you would do what's called a price round, which is really complicated. You're actually giving out equity of your company when you're raising that money, which involves a lot of lawyers to write those documents and make up those like terms or get everything in place that you're doing it legally. And then there's these new investment vehicles that have come up in, say, the last 10 years, like convertible notes, which are a lot more simpler. Can't really go into the full definition, but in general, if you're like raising money for a tech business, convertible notes don't require as much lawyers, doesn't require a lot of paperwork. So it's a lot faster. People invest in your business. That means you can get working sooner on what you're doing rather than just doing with this lawyer hullabaloo signing pages and that kind of stuff. And now there's even newer investment vehicle called a SAFE, and that is even faster for raising money, especially in the early rounds. So there are some things that are being put in place into the tech world to make raising money easier, but in general, all of those downsides that I mentioned are still true. So this is the past, especially if you have a big business and you want to go big. The past was you got to make this choice between venture capital and bootstrapping. And now we kind of have this bootstrapped-ish thing where people are bringing in just enough money, and it's going to be more acceptable to bring in just enough money so that their company can get over, say, that beginning hump of that's long, slow ramp of death. Just enough money that you can get over it. You can use that money in a way that you can get those salespeople, those engineers, that product and whatnot to get yourself to that escape velocity. So there's a lot of different ways of getting just enough money while continuing to keep control of your business. And one thing that's really interesting, and this is something that's gotten more and more popular in the last few years, is called revenue-based financing. And I wanted to put it first because it's something I was not aware of when I was running Wedding Lovely. And it's something that has been really, really picking up in like the last 2 or so years, especially again for tech businesses. So revenue-based financing provides upfront capital in exchange for a set percentage of future revenue. So if you're running a business and you have, you're bringing in capital, they will say, we'll invest in your business and they'll take, say, 10% of your profits for a certain number of years afterwards. So you're, getting a chunk of money early and then you're paying it back over time using your profits or revenue. And revenue is the money coming in, and profits is the money that you have after applying your expenses. So it's pure profit. So that's where you see here in this bootstrap line. This is the new dot that's really become more of a thing in the last few years, where instead of just being like 100% bootstrapped, you can now apply this revenue-based financing. You can apply for these programs that allow you to get that chunk of money up front, as long as they, can get that money back over time. And this is where you can kind of see where having that product market fit, some side of proof of traction is really crucial, because they want to know that you do have that potential to pay them back over time. So this is good for businesses that have existing steady MRR. And if you don't know the term MRR, it's really heavily used in the tech world. Essentially, it means monthly recurring revenue. So this is really great if you're building a product, a tech product where you have people signing up for a subscription, and that like every month that customer is giving you $10. And so when you add that all up, you can say, okay, cool, I have, 6,000 of monthly recurring revenue. You know, these customers have signed up, they've already opted into paying you this recurring revenue. And you can take that chunk of money and say, look, I have this is where I am right now. And then my MRR is going to keep going up as I get more customers. And so these businesses say like, cool, you have this proof. I'm going to, give you that chunk of money. The nice thing about revenue-based financing is investors don't receive equity. They don't take a part of your business. And so this is huge. You continue to own 100% of your business. The maturity is usually 3 to 5 years. And so that's the kind of the time in which they want you, brain's going blank. That's the time that they want you to start paying back, or you have to be finished paying back. I can't remember what maturity means. But there's like this chunk of time in which you have that you need to start paying them back. And there's lots of little technical details it's all different based on the firm that you go with. And because they don't own equity in your business, it keeps the option open. Oops, I have a typo there. Keeps the option open to sell the business in the near future because they don't have any say in that matter. And the important point here is actually in the near future, because say if you raised the venture capital, they gave you that chunk of money, then an offer came in, 2 months later from a really cool business, the investor could block that sale because they're like, hey, I just invested in you. There's no time for me to get my money back, and they want to see you actually grow the business that you wanted to invest in. Whereas like there's no say from this revenue-based financing. So you can get that chunk of money, get that offer, accept that offer, pay back that chunk of money, and you're good. You don't have to worry about any of that hullabaloo. And you can continue to run the business in the long term or raise VC. You have options. They're not going to tell you how you can run your business. So that's really great. And like I said, this is kind of aimed at tech businesses. If you're running a product business, I believe there's revenue-based financing for product businesses. But that's kind of where things get a little bit more hairy, and that's not where my specific expertise is. But I can help. If you are interested in learning more about this area, feel free to ping me and I can do some more research and work with you one-on-one. So kind of going over, or this is like one of the examples of the companies that does revenue-based financing is Lighter Capital. And to kind of show you what the terms of these companies are. So Lighter Capital, before you can put in an application, they want to see that you have $15,000 in monthly recurring revenue minimum. So that's like product market fit, escape velocity, maybe even a little bit more. So you can kind of see that it's like one of those options where you really, if you're bootstrapping your business, you do have to get to a certain level before you can go with something really big like Lighter Capital. But once you get to that level, you can get an investment of say $50,000 to $3 million. All right, that's a maturity, yeah. Maturity repaid over 3 to 5 years. The payments range from 2 to 8% of your revenue. They expect to have the amount of money returned between 1.35 to 2x, because you're not just returning the money, they want to see a return on that investment as well. They need to make money themselves. They're looking at the businesses to see if they have a clear path to profitability, so you have to prove that. And they are US and Canada only, so if you're Europe-based. I know they're trying to move out to Europe, but I think with COVID, I think they just had a big round of layoffs, which is making things a little more difficult. And then I'm going to speed around just a couple other options. There's Bigfoot Capital. They are looking at ARR, which is annual recurring revenue businesses. So they want to see they have between 1 to 10 million ARR, $100,000 to $1.5 million in investment size. Yeah, and they want to see your history, and they want to see that you're bootstrapped or you've brought in a little bit of money beforehand, but they don't want to see someone who's done a bunch of rounds of VC investment. There's a lot of other companies out there that do these kind of things: Pick and Shovel, River SaaS. And if you're in the tech world, this is something I find really, really interesting right now. As Stripe is a payment platform for tech businesses, so this is something I use at Wedding Lovely to manage the subscriptions of the people who sign up for Wedding Lovely and want to pay me that amount for either a business account or for wedding planning help. So I use Stripe and to run the payments part. And the nice thing about Stripe is that they because they're doing payments, they already know how much revenue you're making. And now they're starting to invest back in the businesses that are using their tool through a thing called Stripe Capital. So Stripe Capital invests a lot smaller amounts, but it means that your business can be a lot smaller than these other, earlier options I showed you that have a pretty big minimum. They do charge an upfront fee. So if you wanted to, say, get a $20,000 loan, they do charge a fee of 10%. But you just pay through Stripe a percentage of your sales. You don't have to do a lot of hullabaloo because you are using their payments platform. So you can get that, that big chunk of money that could either then apply to hiring one other person that would then cause you to gain more revenue for your business. And then just through Stripe, that revenue goes back to Stripe to pay off that, that chunk of financing you got. So that's a really interesting option. And I want to see that more things like that, especially smaller amounts of revenue-based financing that doesn't require any kind of selling equity in your business to happen more for some of these more tech platforms. Now there's this whole area of, bank loans and debt financing. And bank loans are, a lot of people are like, that's like the traditional one. When you think about like getting money in your business, I have a business, I'm going to go to the bank and get a loan. And, there's a lot of details here. Loans are based on your revenue, but a lot of times loans come with performance requirements and an equity component. So they're looking at how well your business is doing, and they want to continue to see your business doing well. And so they're going to have those performance requirements, and they could still take a chunk of your business. So they are going to be, in a lot of cases, selling a piece of your business to wherever you get this loan. They also traditionally require a personal guarantee, which is really scary to me, your house, et cetera, all your assets and whatnot. So if something falls through, they have a guarantee to get their money paid back. Loans are often required to have regular payments. So with revenue-based financing, if there's months where your business didn't make any revenue for some reason, you're not required to pay back anything because it's all based off revenue. But with a loan, it doesn't matter how well your business is doing or how poorly your business is doing, they still expect to have their payment every single period. So that's kind of scary. And because of this, it's something you can look into and you can make the choice for yourself, especially if you're a tech business. It's something I don't really recommend. If you're in other businesses, if you're in a physical storefront business, this is something that might be worth it to you, because also loans and banks and whatnot are more used to working with those kind of businesses. But there's so many other options now in the tech world that try to explore these other options that are available to you before moving into loans as a last, use that as a worst case scenario. Another thing that's been really interesting in, say, the last 10 or so years is crowdfunding. So the big one here is Kickstarter. I've used Kickstarter, 4 times for that book I mentioned. Hello Web Design is my self-published book, and I fundraised for the book on Kickstarter. I self-published the book, and I did four books in total. One was a reprint of an existing book, and I did another round of fundraising to pay for the reprint. Kickstarter is actually super great if you are doing a physical product. If you're building something or you're making something to sell, especially for like that initial round. Say if you want to build a clothing business, a lot of people who build these like big multi-product businesses will start out by designing one product super well, selling that one product on Kickstarter, getting all those essentially pre-orders in, that buzz, that launch announcement and whatnot, and then, fulfilling that one object and then either creating more objects and doing it on Kickstarter or then launching their storefront with all the products they have. So Kickstarter is really, really great. If you have a physical product, they sell really well because, Kickstarter is such a visual platform and it's kind of like a store itself now. I love Kickstarter. I love using it for buying products and supporting local makers. I've personally have never actually had a Kickstarter go bad on me, which is great because I have clothing from Kickstarter. I have lots of kitchen objects from Kickstarter and whatnot. So Kickstarter works really, really well. Actually, I should go. There's Indiegogo, kind of the same thing. I want to do them both. And I wanted to talk about how if you're doing say a product-based business, these platforms are really, really great for those, but they're not the best fit for, say, a software-based business, especially if your software is something that's targeting businesses. Businesses are not looking to pay for their, email marketing tool or sales tool or whatever software you're building on something like Kickstarter. But it's a great fit for physical products or perhaps consumer software products, but that is also harder because it's a lot harder to have those visuals, and a lot of people are using Kickstarter for those physical materials, physical products. So as mentioned, physical products are a great fit. And I have seen people had some amount of success raising money for brick and mortar stores, but only really if they have an existing audience. So if say there's like an ice cream store that I backed that was in Portland, just because I wanted to support that local maker. But really, if that person in Portland was really raising from their outside community and just raising from their community in Portland, their specific previous customers, and their customers like helping share with other people in that area, and really just using that platform as a place to get those payments. But it's not something you're going to get like a lot of worldwide attention from. You're not going to get like a lot of money like a potential physical product that goes viral. And then this is where my current job comes in. There's a new trend in the last, say, 3 or so years where there are bootstrapper funds and accelerators. So this is, again, back into the tech world. But because before there was for the tech world, there was this again, that gap between bootstrapping and venture capital. Now there's this idea of, what if a fund invested in bootstrap companies, but had the terms and the expectation that those bootstrap companies are not going to raise that that VC afterwards, go on to that VC roller coaster ride that I mentioned earlier. A lot less pressure, a lot less ownership taken from that company. So these are kind of been called alternative investments, where there's no board seat taken, there's no controlling interest. Dividends are an option. So if you have a business and at some point you need to pay back your investor some way, shape, or form. Before it would be just through an exit or an IPO, but I'll go into TinySeed in a second, but this is something that TinySeed does. You can issue dividends to the shareholders of your company, and that could be the way that you pay back your investor is through those dividends. So it's like a specific hey, this company has a chunk of money. I want to release this chunk of money to the people who are owners in the business through dividends, and investors can take a share of that, which means that the investors are not hoping for an IPO or an exit, and therefore not pushing you into doing those things. Some technical details. A lot of VCs, venture capitalists, will only invest in C Corps, and which is they only invest in US-based C Corps. And a lot of investors are US-based. Even for the Canadians, I know a lot of people will reincorporate in the US as a US company so they can get their US-based investors. I'm actually American myself. I don't have a good handle in terms of what the terms are in Canada yet, just because the investment world is so US based. But some of these alternative forms will also invest in LLCs, which is a more founder-friendly company formation type. And I know that TinySeed itself is starting to expand out into other countries. We just did our first investment in a French company. And so in general, these alternative venture capital firms are not expecting you to be a US C Corp business requiring to reincorporate and do this more onerous company structure. And then all these firms, like I said, are not future rounds. You can raise money, but it's not required. A lot of them are expecting healthier, sustainable growth, which can translate to slow growth, which can translate to a lot less stress to you as the founder. You're not expected to go big super fast or to shut down your business and do something else. And then, as mentioned, it's not necessarily US only. A lot of these companies are already based in the US. They usually start out as US only. But as this new middle section gets bigger, it's going to be it's going to grow to other countries. And I can see Canada coming in pretty soon. So a couple of the players in this area, first one I want to mention is Indie.vc, which is really the first one that kind of launched this like this alternative venture capital firm. So IndieVC is funding for simulated equity. They don't actually own equity in the business because it's, if I recall the terms correctly, as you pay back the business, their simulated equity amount will go down. Whereas if they actually own equity, then there'll be a lot of paperwork to track how much they actually own the business at any one time, which is why it's called simulated equity. I think it's just like, it's kind of like an agreed upon amount that isn't put into paper until there's an event. They're kind of like revenue-based financing because they require, when you start paying back their funds, it starts on a schedule and it's a percentage of your revenue. And then once it's paid back 3x, once you've paid them back 3 times of what they've invested in you, then the equity that they own is brought down to 10% of the original amount that they owned in the business. If the company sells, is converted to real equity. So say you sell your company for $1 million and EVC own 10%, they get 10% of that million, essentially. And they do have, this is a place where, again, they do want to see, they don't invest in idea-based businesses. They invest in people that already have some amount of traction. So the average monthly recurring revenue is usually at the $25,000 range, which is pretty high. And they have specific application periods. So instead of just being an investor that takes in people, they have specific periods for companies to say, to apply to be funded by them. So they're revenue-based financing, kind of in that way, because I mentioned they take revenue. So they're nice because they put all their terms online. I see I only have like 12 minutes left, so I'm gonna try to speed around the rest of the information here. Move on to TinySeed, which is where I work. I run the program, the accelerator program at TinySeed, along with my 2 bosses and a coworker that runs our events. So we're very small, we're just 4 people. TinySeed is a 1-year remote accelerator and investment. So we have a specific focus on a very small niche in the tech industry. We're specifically looking for businesses that are building software products for other businesses, which is what B2B, business, SaaS business would be. That's a lot of business. The B's, I think that's a little repetitive, but you get what I'm saying. We invest $120K to $200K per company for equity. We get paid back via dividends, not revenue, or an exit. So we are not revenue-based financing. The way we do dividends, which makes sense, is that founders have a salary cap. And so say the founder is capped at a certain amount, which is like an engineer in their city. And when they want more money, when the business is so successful that they think they can have a chunk of money back from the business, that is also when TinySeed gets paid back. So the fund only gets paid when the founders get paid, and we don't take a board seat. We require a typical monthly recurring revenue of like a minimum of $2,000 per month. So our requirements are a lot lower. We don't allow repurchasing back of shares. So we continue to own the equity in the business no matter what. We don't allow people to buy back the equity from us. Generally, US-based LLCs or C Corps. We invest in a lot of international founders, but a lot of those international founders will reincorporate as a US LLC. But like I said, we just did an investment in a French business, so that's starting to expand. And we have application rounds. So if you're a software business, there's 3 of us. There's TinySeed, there's Indie, there's Earnest. This is a cool article that kind of goes over the differences between our 3 programs. And this is just a bunch of tweets from someone who's in this industry, where someone was saying essentially that, taking VC, people are like, why would you do that? And he was saying that capital is a tool. Is a tool you can use. And if it's something that goes up for everything we've mentioned before, capital is a tool that you can use for your business. All right, super speed round. Sorry, running out of time. Sorry, I was really talking a lot. All right, grants. There's a lot of grants out there. It is overwhelming how many grants are there. Too many options to list here. But for any grant program, make sure to double check your eligibility, because grants usually have specific requirements. They're looking for minority-based, minority-owned businesses, women-owned businesses, bunch of different requirements. A lot of them are really niche. So double check the programs that are out there, double check your eligibility, make sure that you're not wasting your time applying for them, create a system for those applications. Government Canada is really cool. They have this tool. The URL is really hard to remember, but if you search for Innovation Canada support for your business, it has this little walkthrough. You're like, hey, I'm looking for this kind of support for my business, specifically so-and-so, and then you can fill out these different options and it will just list out all the grants that could be available for your business. Super cool. Totally recommend using this. There are a lot of different state and local businesses, like things in Canada, things in your specific area. It's overwhelming, but it's out there, and if you make it through, the time is worth it to you, it's technically quote unquote free money because they don't require you to pay it back. Last but not least, I believe it's last but not least, friends and family. You can raise money from your friends and family. It can be an option for you, but be okay with the chance that you'll never be able to pay them back. For me, it is not worth it. It could cause a rift in your relationship, because businesses are temporarily, but friends and family hopefully are forever. But that is an option. I want to put that here, that some people have been able to fund their businesses by taking loans from friends and family. And it has, you don't have to worry about lawyers, payback periods, all that kind of things. Now, this is where I'm going to wave my hands and say that there's more. And if you Google for it, it can be overwhelming, especially for different kinds of businesses that are not tech businesses. So if you look up for financing for small businesses, there's other things like purchase order / invoice financing. There's cash advances. There's other things that could be available in your specific business niche. And there's another thing I found, which is called ifundwomen.com, which I think is really interesting. So there's specific programs that are out there just for women, just for networking and raising capital and gain coaching. A lot of people are out there who just want to support women entrepreneurs that has capital as a part of that system. Whew. All right. That was a lot. Like I said, the slides will go up online. There's a lot of information here. Feel free to chat with me online anytime at Tracy Makes on Instagram or Twitter or whatnot. And awesome. We have a few minutes for questions.
Yeah. And are you able to stay just beyond the 11 o'clock mark, Tracy, in case?
Yeah.
Okay. So if anybody has a question. Yeah.
I timed it earlier and it was going to be shorter than this, but
it's always the case because you're passionate about what you're talking about. There was one question that came up earlier in the chat, and it was regarding crowdfunding. So I don't know if you wanted, Julie, did you have a specific question on aspect of crowdfunding? I think you can unmute yourself if so.
Tracy, thank you very much for such an excellent presentation, by the way. Hi. I'm sorry I joined you a little bit late, but I was wondering if we could chat offline. I have about 4 or 5 coffee table photo books that I've been going through my mind, and I've pinned down a printer, and rather than, the risk of printing 1,000 copies of one book, that's what got me thinking to spread that opportunity cost over several books. And so I am trying to, as a photographer, monetize my extensive digital library of images, and anything that I don't have, I've been shooting now, like life on a farm, bees, and all these other things. I spent an afternoon at a lavender farm yesterday, the largest in Ontario. So that really resonated when you mentioned that you yourself have done some of this funding with your books, and so congratulations on that. But I would love to follow up with you on that.
Yeah, definitely send me an email. It's if you just Google for my name, or you can DM me on Twitter or whatnot. I'm pretty easy to find on the internet. I'd be happy to help you out.
And we dropped your email into the chat as well. So
cool. Yeah.
Tracy@tinyseed.com. Super easy.
Yep. Yep. That works.
Barbara also had a question. Barbara, you want to go ahead?
Hi, everybody. Just want to show off my booth from a conference last week. But also, thank you very much, Tracy. I appreciate your time. It just happened to be the Zoom background that was up. My question is regarding using tools for investor research. I was part of Collision recently, and we had access to PitchBook, and it looks really amazing. The timing is right for me to use something like that. I was wondering what your opinion of the pricey license access would be, if you know of other startups that
Ooh.
fit for pre-seed, seed, and if the return on investment is worth the cost.
Ooh, that is an excellent question that I don't have personal experience with any paid platform for finding investors. I will say that when I was raising money for Wedding Lovely before, and my experience in the venture capital industry, that I don't know about that program in particular, but there are programs out there that you pay money for, and then it doesn't come out that it works for you, and then you're just out of money, you know? So what I counsel for anyone who's looking for like that initial stage, it is a lot of networking, and it's probably would be really useful to you to kind of like look at your connections, look at LinkedIn, see if there's any investors in that early stage, maybe not for investing particularly in your business, but just to get advice from. And then sitting down and having those Zoom meetings, you know, love to say you can be in coffee. But for me, when I was like raising my initial round, a lot of it became, I just like looked at my network and I sat down, I got like an intro to an intro to an intro to another person who was able to sit down with me, talk with me, and kind of go over my business, talk about the way to pitch my business, the way they thought that I could be successful, and then get connections from them. And then they would connect me to another person. I would sit down with them and then say like, it takes time, but finding investors takes time. But by working through networking, then say through some of these automated platforms, you could potentially get more advice and go farther without potentially having to pay a fee. So I would recommend trying that first. Do whatever you can not to pay money to find investors in the beginning. And then once you feel like you have a good platform on how to pitch and how to, really showcase your business correctly to investors, then you can take the decision to pay money to then reach that network. Because it would suck if.
Yeah, that's where I am now, which is why I was wondering if you knew of PitchBook. Do you know Yuri Lipsit by chance?
Name sounds familiar, but I don't think I know them.
Okay. That's okay.
Mm-hmm.
I just wondered if you'd known of anybody that had used the software. So that's fine.
Yeah, I don't.
Appreciate it. Thank you so much.
Mm-hmm.
Yeah, if anybody has heard of or has used PitchBook or knows someone who has and wants to drop a note in the chat as well, by all means, feel free. And I know Barbara's a little further ahead in her business. So really, there's all sorts of options out there. Any other questions? I'm trying to see if anyone's raised their hand, but if anybody just wants to unmute themselves, feel free. Thanks, Monica. Yeah, Monica mentions the Economic Development Authority too.
Might be great.
Able to provide some leads.
Yeah, I wish I could see the chat. The way I have my screen sharing set.
Oh yeah,
it hides the chat
that's
for me.
Okay.
So I have no clue what's going on.
No, that's okay. You'll see it later. And somebody also mentioned Crunchbase as well.
Oh yeah, do research on people. But like in general, when it comes to like finding investors and even for all these things, spend time doing research first, especially before you pay out money. Because there's a lot of programs out there, maybe not PitchBook, but other ones definitely that are just kind of taking advantage of new entrepreneurs by charging a fee up front and then not really returning in any way, shape, or form.
Tracy, I have a quick question, and that is, do you find, just because we're a group of mostly at this point women entrepreneurs in the room today, would you say that these alternative funding models, you see more women applying for them, or is it?
Absolutely.
It seems to resonate more with the women I've talked to and the clients I've talked to.
So that's the thing with venture capital, because I told you like there's such a huge networking component to venture capital, it automatically gives an advantage to white men, because like networking is so based on like people's vision of the perfect like entrepreneur and whatnot, and venture capitalists are looking for like the person that fits their model, which is usually like a robot Zuckerberg, and so these alternate financing things are often aimed more at underrepresented founders because it gives them the sustainability that they need. Because venture capital, they require people to do that go big, go home, stay up for, working on your business for 18 hours a day because they want to see the return on their business, which often only single white dudes in their 20s can do. But if you're a woman with a family, or a man with a family really, or you have other circumstances, these alternative forms of businesses, and this is one of the reasons why Tiny Seed exists, is because we want to give people the ability to build the business at the rate that they want to, which leads for more sustainable lifestyles as compared to, say, traditional venture capital. So before, people were choosing bootstrapping because that's the only thing they could do when they're also juggling a family, juggling schools, or juggling a life while building their business. They thought the only thing they can do is bootstrap their business. But now there's these other areas that are easier access for people who are not a white dude in their 20s to gain the capital they need for their business while still, living a good life.
Yeah, that's a really good point. So I know that we've just scratched the surface today. I always say these hours are like power packed. And Tracy, I was like, oh my gosh, I hope she has a glass of water nearby, because you packed a lot into that hour. We're so grateful. And I know that there are some folks that saw in the chat, I mentioned that a recording of today's session is certainly available. If you want a copy, just email me, and my email is in the chat. But if you didn't see it, it's carrie.ramsay@queensu.ca. Feel free to reach out, and it will also be up on our YouTube channel. We do have other workshops coming up as well. So if you're not a part of our weekly e-newsletter as well, mention to me when you email that you'd like to be on that, because we do have regular workshops. And I think we've had more than 20 now that COVID has started. So Tracy, we want to thank you on behalf of the group. And I see some thanks that are popping into the chat as well. But just an excellent job and good luck. And such a pleasure to have learned from you today. Thank you.
Thanks, everyone. Lovely being here.
Enjoy your day, everyone.